20% of $1 million is $200,000, and that's how much money most people think they need to get their foot in the door when buying a property. Let's say that this $200,000 is represented by this glass of water that's completely full. Now, can you do the same thing and obtain a mortgage from a lender with half that amount? With $100,000? How about a quarter? $50,000? Well, let's talk about all these options and see where they take us. Before we jump into the conversation, I want to tell you that at the end of the video, I'm going to be giving you two specific property types that not a lot of people know or think about. And those two are the hidden gems in the current real estate market. Let's kick things off with the biggest program out there, available through Canada Mortgage and Housing Corporation, also known as CMHC. CMHC is a crown corporation responsible to the Parliament through a minister. And the main mandate of corporate activities is to provide mortgage loan insurance to lenders against mortgage default by consumers. The programs that the corporation is offering, allowing consumers to purchase property with as little as 5% of a down payment. Let's go through the details. Let's talk about the down payment options first. Minimum down payment of 5% for homes priced up to $500,000. For homes priced between $500,000 and $999,999, i.e. $1 below a million, the minimum down payment is 5% on the first $500,000 and 10% on the remaining amount. Homes priced at $1 million or more are not eligible for CMHC insurance and require a minimum down payment of 20%. Next topic is the insurance premiums. The insurance premium is calculated as a percentage of the amount being borrowed. The premium rates are as follows. If there's a 5% down payment, the premium is 4% of the loan amount. 10% down payment, it's 3.1% of the loan amount. 15% down payment, 2.8% of the loan amount, and 20% down payment, 2.4% of the loan amount. Eligible properties are anything and everything that's located within Canada. And as far as eligible property types, they include single-family homes, semi-detached, duplexes, triplexes, fourplexes, townhomes, condominiums, and manufactured homes. The home must be suitable for year-round occupancy. Requirements for borrowers. The borrower must meet the lender's requirements for a CMHC insured loan. In other words, you have to get an approval from a lender first and then get insured through CMHC. The borrower must have a good credit history and sufficient income to cover the mortgage payments and other housing costs. And the total debt service ratio, also known as TDS, should not exceed 44%, and the gross debt service ratio, also known as GDS, should not exceed 39%. The maximum amortization period for CMHC-backed programs is 25 years. The borrower must intend to occupy the home. Investment properties and rental units are generally not eligible for CMHC insurance except in the case of certain rental programs. New purchase loans, refinancing, and purchase plus improvement loans are eligible for CMHC insurance. And last but not least, CMHC-based mortgage loans insurances are portable, which means that it can be transferred from an existing home to a new home, potentially saving on insurance premiums. Next one on the list is FTBHI, also known as First-Time Home Buyer Incentive. And this particular incentive has specific eligibility criteria. It's only available to first-time home buyers, but let's go through this in detail. You must be a first-time home buyer. This means you have never purchased a home before, you have not occupied a home that you or your current spouse or common law partner owned in the last 4 years. Your total annual qualifying income must be $120,000 or less. This includes the combined income of you and any co-borrowers. The total borrowing amount is limited to 4 times your qualifying income. In this case, it's $480,000. This means the maximum mortgage amount you can obtain plus the FTHBI amount should not exceed 4 times your qualifying income. Again, $480,000. For properties in the Toronto, Vancouver, or Victoria Census metropolitan area, the total borrowing amount limit is increased to 4.5 times the qualifying income. So in this case, that would equal to $540,000. So that would be the amount that you'd be able to spend, and you'd be eligible to get the first-time home buyer incentive and apply for mortgages through that. And this means that you must live in the home. It cannot be used as an investment property or a rental. And when it comes to the down payment, you must have the minimum down payment to be eligible. The minimum down payment is 5% of the first $500,000 of the home's purchase price, or 10% of the portion of the purchase price over $500,000. Next one is Home Buyers Plan, or HBP. It allows people to use their RSP funds to fund the down payment requirements for a house purchase without incurring tax penalties, provided that the money is returned back into the RSP within the specified time frame. Let's go over the details. You can withdraw up to $35,000 from your RRSP. If you're purchasing with a spouse and common law partner who also qualifies, each person can withdraw up to $35,000 for a total of $70,000. You must be a first-time home buyer, which means you have not owned a home in the 4 years preceding the RSP withdrawal. If you're purchasing a home for a related person with a disability, you may also qualify even if you're not a first-time home buyer. The home must be a qualified home, which includes single-family homes, semi-detached homes, townhomes, mobile homes, condominiums, and apartments. The home must be intended to be your principal place of residence within 1 year of purchase or completion, because you can also build a home with this program. The repayment terms are like this. The funds withdrawn under HBP must be repaid to your RSP within 15 years. Repayment starts the second year after the year of withdrawal. For example, if you withdraw in 2024, your first repayment year is 2026. Each year, you must repay 1/15 of the total amount withdrawn. If you withdraw $15,000, you need to repay $1,000 per year. The funds must have been in your RSP for at least 90 days before the withdrawal, and you can only withdraw amounts that are not locked in under other retirement plans or pension programs. Now, let's talk about tax implications. Withdrawals under the HBP are not included in your income and are therefore tax-free at the time of withdrawal. If you fail to make the required repayments, the amount will be included in your income for that year and will be subject to taxes. And there's also this little icing on the cake for the first-time home buyers, which is a first-time home buyer tax credit, which is a non-refundable $5,000 tax credit, which translates into a $750 rebate upon the purchase. That's only available to the first-time homebuyers. Having talked about the federal programs, let's now shift gears and talk about the provincial programs for the province of Ontario. The first one on the list is the Land Transfer Tax Refund Program. It provides rebates on the provincial portion of the land transfer tax for first-time homebuyers. It's available to first-time homebuyers in Ontario. Second one here is the first-time home buyer tax credit. That's provincial. It matches the federal tax credit for the first-time home buyers. In other words, it gives you a non-refundable $5,000 tax credit, which translates into a $750 tax rebate. And that's also only available for first-time home buyers in Ontario. And these are the programs that are available to consumers either federally or in the province of Ontario. Now is the right time to talk about something that I promised to cover in the beginning of the video, and that is two property types that not a lot of people know about or think about when it comes to their purchasing decisions. And those two property types are cooperative buildings and co-ownership buildings. There are a few locations in the city of Toronto where those buildings are clustered, and they usually are sitting in the same locale. And the biggest difference between those two property types, say in a condominium, is the price point. Let's take an example. Say you have a 20-year-old condo building somewhere in Midtown Toronto where a 2-bedroom apartment is selling for $700,000. You find a co-op or co-ownership building with a unit that is sized similarly to the one in the condo, and that one would be selling for approximately half the price, or roughly $350,000. You would say, well, it's a no-brainer, let me jump in. But there are a few caveats that I want to cover as well. First of all, from the perspective of the mortgage requirements, you will not be able to obtain a mortgage from a regular chartered bank. You would have to go through one of the credit unions that are servicing these types of buildings. And it has to do with the fact that you're actually not obtaining a mortgage, you're obtaining a loan, at least in the case of a co-op, whereby you're buying shares of the corporation that owns the building. Second consideration is that the down payment requirements will not be covered by any of the federal programs. 5% option through CMHC, 10% option, 15% option, or even a 20% option is not an option when it comes to co-ops or co-ownerships. You most likely have to pay a 30% down payment. But again, considering the price point, this could be the most straightforward way of getting your foot in the door of the real estate market in Toronto, given the current price points. So guys, as you saw, there are plenty of options that would allow you to get your foot in the door without having to commit to a 20% down payment. Two notable exceptions are, of course, co-op units and co-ownership units, where you'd have to pay a higher down payment. But at this point, I would really suggest that you start having a conversation with a mortgage broker and a real estate agent, because those two professionals will help in directing your efforts. In the first case, in finding the right mortgage for you, and in the second case, in finding the right property for you. So to that end, I'm including a link to our calendars in the description box below. The process is simple. You click on the link and you choose the time that works for you and the time that works for us, and it's either myself, Vlad, or my partner Mitra. We're going to have a 15-minute phone conversation with you where we're going to talk and answer any of the questions that you have. Plus, we're going to talk about your specific objectives. That's about it, guys. If you liked the video, please consider subscribing to the channel, hit the like button. Please leave your comments in the comment section below. I'm always engaging my viewers through the comments. And I would also encourage you to share this video with anybody who you love and care about if you think this material could be useful for them. That's about it. I'm looking forward to seeing you again next week.